Imagine taking the giant, concrete floor, bulk buying warehouse experience we all know. The pallets of paper towels, the massive jars of mayonnaise, and just kind of shrinking it down a bit and dropping it into 12 different countries.
Right, which sounds completely chaotic.
Oh, totally. Because each of those countries operates with its own currency, its own intensely complex tax laws, and entirely unique consumer habits.
Yeah, you're essentially taking a highly specific, high-volume retail model that was perfected in sprawling U.S. suburbs, and you're stress testing it across a deeply fragmented, highly volatile geographic map.
Okay, let's unpack this. Today we're taking a deep dive into a stack of financial documents, specifically the Q3 2026 Form 10Q and the earnings release for a company called PriceSmart.
And for context, this is a U.S.-style warehouse club, right?
Exactly. And for you, the listener, whether you're an investor looking for international retail insights or you're just insanely curious of the hidden mechanics of global business, we want to figure out how this model doesn't just survive, but actually thrives down there.
To set the baseline, PriceSmart operates 57 warehouse clubs across 12 countries and 1 U.S. territory. Right now, Colombia is actually leading the pack with 10 clubs.
Wow, 10 in just Colombia.
Yeah, exactly. But their footprint stretches across Central America, the Caribbean, and South America. So they're navigating varying degrees of infrastructure, different regulatory regimes, and vastly different economic realities all at once.
And like we said, they aren't just surviving in Latin America and the Caribbean. To truly understand the mechanics of their strategy, we have to look at the scorecard.
Right, the latest numbers.
Yeah, the quarter ending May 31, 2026, and the headline figures are booming. Total revenues hit $1.48 billion.
That's wild.
It's a 12.5% increase over the same period last year.
Which is an exceptional top-line figure for physical retail right now, especially in this macroeconomic environment. And it's translating directly to the bottom line, too. Net income jumped nearly 13% to $39.7 million, or $1.28 per diluted share.
Yeah, and when you look at comparable net merchandise sales, so, measuring the clubs that have been open for over 13 and a half months to get a true apples-to-apples metric, those sales increased by 10.7%.
That's the kind of organic growth that retail executives usually only see on a whiteboard.
Literally. But looking closely at the balance sheet, there's a massive external factor at play here.
Yeah, what's fascinating here is the sheer scale of their foreign exchange exposure.
Right.
When you operate across a dozen sovereign nations, you're dealing with a dozen different economies fluctuating against the U.S. dollar in real time.
Which is a lot to juggle.
Exactly. And this quarter, foreign exchange rates actually served as a massive tailwind. The translation of local currencies back into dollars positively impacted their net merchandise sales by $50.6 million.
Oh, wow.
Yeah, it's a 4.0% bump purely from the mathematical translation of currency strength.
Wait, so if we strip away the lucky break from currency exchange rates, how healthy is the actual core business? Are they really growing that fast?
Well, even on a constant currency basis, comparable sales were up a very healthy 6.9%. So it proves the underlying business is genuinely expanding, not just riding a favorable exchange rate.
Okay, that makes sense. Because I was looking at that constant currency basis in the footnotes, and I was thinking this underlying growth isn't just an FX mirage, right?
No, not at all. It's a critical distinction to make. A lot of multinational companies will mask declining physical volume behind a strong local currency, but PriceSmart isn't doing that.
Right.
That 6.9% constant currency growth proves that foot traffic, ticket size, and physical pallet movement are all legitimately expanding. They're basically putting more items into flatbed carts regardless of what the central banks are doing.
Yeah, and if the core engine is moving that much organic volume, the logical next step is expanding the footprint. PriceSmart outlined 3 major drivers of growth, but the primary one is just simply adding new physical locations.
Yeah, they have some aggressive physical expansion plans.
Right. They are pushing to reach 63 clubs by the spring of 2027. I saw they just purchased a 6-acre property in Heredia, Costa Rica to build their 11th club in that country alone.
Which really represents their traditional, highly successful playbook. You identify a growing suburban area with an expanding middle class. You acquire a massive, cheap plot of land. You pave an enormous parking lot. And you build a highly efficient, no-frills steel box.
Classic warehouse club stuff.
Exactly. It relies on cheap real estate to offset the low margins of the goods inside.
But here's where it gets really interesting. They also announced their planned entry into an entirely new country, Chile.
Right, opening in the spring of 2027 in Santiago.
But they aren't buying a sprawling 6-acre lot on the outskirts of the city. The 10Q explicitly states this new club will be located inside the Mall Plaza Las Dominicas shopping center.
Inside a mall.
Inside a traditional mall. I mean, that feels like trying to parallel park a school bus.
It really does.
The entire mechanical design of a warehouse club requires vast horizontal space, massive loading docks, shoppers pushing those crazy oversized carts. How do you integrate a high-volume bulk operation into a premium shopping mall?
Well, if we connect this to the bigger picture, it makes brilliant strategic sense, even if it seems operationally counterintuitive.
Okay, how so?
Santiago is a dense, premium, highly developed urban retail environment. The affluent demographics they want to target are heavily concentrated in urban cores, where a 15-acre suburban footprint simply doesn't exist.
Or it's just way too expensive.
Exactly, prohibitively expensive. You can't just impose the traditional U.S. suburban model onto that specific geography. This location offers premium demographics and excellent accessibility via public transit.
So they're fundamentally adapting the physical footprint to gain access to that specific consumer base.
Yep, it represents a highly localized adaptation of the U.S. warehouse model. It acts as a beachhead for a multi-club market in Chile.
So they are generating over $1 billion in revenue, moving massive organic volume, and breaking into premium South American real estate. But reading through the footnotes, a slightly jarring narrative emerges.
Oh, you mean the back office reality?
Yeah, exactly.
Yeah.
When you look at their actual liquidity, a massive chunk of their cash is effectively trapped. It really prompts the question of what the hidden friction looks like when you're operating across 12 different foreign governments.
Yeah, it's a labyrinth of aggressive tax codes and restricted cash.
Let's dive into the tax receivables section in the footnotes, because this blew my mind. PriceSmart has $36.7 million tied up in value-added tax receivables.
Wow.
And even wilder, they have $59.3 million tied up in income tax receivables.
That is nearly $96 million of their cash currently sitting with foreign governments just waiting to be refunded.
Why are these numbers so high? I mean, how does a company end up overpaying by almost $100 million?
It's structurally built into the regulatory framework of emerging markets. In many of these jurisdictions, governments actually force credit card processors to intercept a portion of the retail sale.
Wait, really? The credit card company?
Yeah. They intercept it and remit it directly to the government as an advance tax payment.
It's like running a restaurant where the credit card company intersects 20% of every dinner bill to pay next year's corporate tax, but you still need cash today to buy tomorrow's ingredients.
That is precisely the mechanism. And it leaves PriceSmart in a perpetual state of having overpaid their taxes, which they then have to fight to get refunded.
I imagine those refund processes aren't exactly quick.
Not at all. They can take months or even years of bureaucratic wrestling to resolve.
And there's another wild detail in here about an alternative minimum tax. It notes that in some countries, minimum tax rules force the company to pay taxes based on a percentage of their total sales.
Yes, rather than a percentage of their actual income.
Which is crazy for a warehouse club. I mean, think about the math. If you sell a $100 bulk item, but only make $2 in net profit, a traditional income tax takes a cut of the $2.
Exactly.
But a sales-based tax takes a cut of the entire $100. If that rate is just like 3%, you've already lost $1 on the transaction before you even turn the lights off in the store.
Right, it creates massive structural overpayments. And that isn't even the only cash they can't touch.
Yeah, I saw the restricted cash line item. They have $46.1 million functionally locked up.
Which is fascinating when you look at the breakdown.
Yeah, they're forced to hold about $31 million in Trinidad dollars and another $7.1 million in US dollars just to satisfy regulatory requirements or as compensating balances for local bank loans.
The situation in Trinidad is actually a perfect illustration of this friction. PriceSmart is forced to hold tens of millions in local currency just because of structural foreign exchange shortages.
It's like trying to run a marathon while wearing ankle weights. They have over $140 million effectively locked up by foreign governments and banks. How does a company manage this drag on their liquidity?
That brings us to the actual economic engine that funds this whole operation.
Right.
The mechanism that allows them to survive these massive cash flow traps without taking on crippling debt.
The membership model.
Precisely. It generates highly predictable upfront cash.
The 10Q shows they pulled in $25.7 million in membership income just this quarter. But it's not just an entry fee, right? It's like a deferred revenue engine.
Yeah, especially their platinum tier. It gives members a 2% rebate on most items, up to a maximum of $500 a year.
And they issue this rebate once a year on March 1st, and members have until August 31st to use it.
This raises an important question, though, from an accounting perspective. How do you account for loyalty?
Right, because you have all these rewards sitting out there.
Exactly. You have to account for breakage. PriceSmart estimates that 5% of those platinum rewards will simply never be used.
People just forget or lose the voucher.
Yep. So they eventually recognize revenue from those unredeemed rewards and expired points. But these programs aren't just perks. They create a closed-loop ecosystem.
Which brings us to the co-branded credit cards. This completely shifted my perspective on the company.
Oh, the co-branded cards are a huge piece of this.
Yeah, the document states that in certain countries, PriceSmart actually receives a portion of the interest income generated from the average outstanding balances on those cards.
Yes, the interest-generating portfolio.
They're taking a cut of the interest when their members carry a balance. They've created an entirely separate revenue stream just for being the hub of their members' financial lives.
It's essentially a localized, low-risk shadow banking revenue stream layered right on top of their retail operations.
So what does this all mean? For you, the listener, the lesson is that true international business success isn't about imposing your exact model on a new country.
No, not at all.
It's about bending your model just enough to fit local realities, whether that's wild foreign exchange swings, intense local tax schemes, or navigating unique real estate challenges like a mall location in Chile while keeping your core economic engine intact.
And it leaves us with a really provocative thought to ponder.
Oh, what's that?
Well, as PriceSmart expands into more affluent, highly developed markets like Chile, will their traditional model of selling U.S.-style goods at low prices hold the same magic? Or will they eventually have to evolve from being a warehouse club into a localized lifestyle brand?
Oh, wow. That is a massive question to think about, evolving beyond just the warehouse box. Well, thank you for joining us on this deep dive into the fascinating mechanics of PriceSmart. Have a great rest of your day.